Hi everyone, Leighton Roberts here, one of the co-founders of Sharesies, here with Jenée from interest.co.nz. Just before we get into any detail, it'd just be great if you could give us a thumbs up if you can hear and see us okay. Just waiting for some sort of reaction here.
Yes, we've got one.
Yes.
Yeah.
At least one
And
person.
another one. Yeah, good.
All right, that's great. Well, thank you so much for joining us, everyone. We thought it was a great time to get together and have a chat about what's been happening in the markets. A little bit of volatility, maybe a little bit more than a little bit. In some cases, I know, looking at my own portfolio, it's always a bit unnerving to see some pretty big numbers wiped off on percentage, or at least that's how it feels. So we thought we'd hopefully share some of the insight that we've had. Jenée, thank you so much for coming along and joining us. Maybe you could just give everyone a little bit of an update on what you get up to day to day.
Cool. Well, thanks so much for having me. I am a journalist for interest.co.nz, which is a financial news website, and I'm based in Wellington at the Parliamentary Press Gallery. So I write about basically decisions the government makes that affects the economy, and I also have an interest in personal finance, so write a wee bit about investments and banking and insurance and that sort of thing. And I just have an interest in these topics. I'm not a financial advisor. I mean, if I was really good at the stuff, I probably wouldn't be sitting here talking to you because I'd be on my luxury yacht somewhere, so don't take anything I say is financial advice. But I do watch what people say, and hopefully I can sort of, that can be useful for people.
Yeah, and I guess that goes the same for me. I'm also not a financial advisor. I'm a very passionate investor, obviously one of the co-founders of Sharesies, so very interested in this and do have some opinions and do a lot of reading on lots of experts and what's going on, and have been following the news pretty closely, which has been great. And we've also got an awesome bunch of insight out of our dealing team and stuff at Sharesies as well. So to everyone out there listening, thank you so much for tuning in and for the questions you've given so far. And we might as well just start right with the first one. And Jenée, it might be a great one for you to give us a bit of insight on, which is why have share prices dipped?
Right. So as everyone knows, the share market has been going really well for a number of years now, and actually perhaps longer than people thought a few years ago. I was sort of waiting for things to dip off because I thought this can't keep going, but it's just kept going. And then end of 2018, there was some major jitters with like China-US trade war, and things dropped off, and those gains came back again. And now there's the coronavirus, of course, and it seems like markets took a while to react, but then when they reacted, they well and truly reacted. And as most of you are probably aware, you've seen major dips. It's been interesting to actually see that the US markets haven't seemed to have taken as much of a hit as the Asian and European ones. But it's after generally a long period of market going up, we're seeing some volatility now, but it's kind of not unusual, right? Markets go up, markets go down, and currently they're going down.
I mean, that's a great point. I think one of the unusual bits is probably the sustained increase for such a long time. So I would say, though, that the 4% dip that we saw in the US a couple of days ago, it's the worst in a couple of years in a single day. And interestingly, in the last couple of days, and particularly overnight last night, it had a couple of good cracks at recovering. So there's obviously still a fair bit of positive sentiment out there as well. But it all ended up sort of flattening off. And if we look at the New Zealand market today, there's been some really promising results. So A2 Milk came out with a great result, and that's trading up quite a bit today. So some of those recoveries are starting to take place, but it just shows how these different levers. So the coronavirus is obviously the one that's topical everywhere. So one of the interesting things about when markets start to go a little rougher is they get a lot of media attention. So I'm really interested to ask you, as a journalist, why we think this is the first announcement when I wake up on the radio, New Zealand Bulletin and stuff in the morning now, but quite often it's really hard to get business news. So what is it that's getting so much, why is it getting so much more attention this time?
Well, I suppose the nature of this sort of an event is scary. It catches people's attentions. You see these sort of crazy images coming out of China where the streets were once bustling and now people are being confined to their houses. They can't go to work. These sorts of things people can relate to and they think, oh my God, that is, quite terrifying. So there's that human element to it. And then I suppose when markets, those drops that you talked about before, Leighton, when that starts happening, I mean, that is definitely newsworthy. The thing about this, though, is, just the uncertainty around it is the bit I think that is concerning. So I know I keep seeing these different economists have different forecasts, and even Treasury is looking at different scenarios as to what could happen and how the government might respond, and the Reserve Bank's doing the same thing. But I just think this uncertainty around it all makes it kind of that much more intimidating for people. Yeah,
I think that's a good first takeaway word maybe for the session, which is I'm sure everyone here has heard it before, but it's great to reiterate. Markets like certainty, they don't like uncertainty. And no one really knows the impact yet of what the coronavirus might have on things like travel, tourism, export. So we're seeing that if you look at the local market, the ones that were impacted first was really those sort of companies related to that. So even some of our really sort of strong performers, historically, like our ports, because of that uncertainty, they've generally tended to be quite certain sort of investments. So some of them are experiencing it and might not normally have done so. And I just want one more point quickly on the coronavirus, which is it's in other big sort of pandemic type environments like this, where there has been a lot of media attention and a lot of uncertainty, then the markets have reacted similarly in the short term. But if we look back at the SARS one, for example, by the end of the year, they did work their way through. So once we get more information come to hand, things like what's happening or what the actual impacts will be, then I'm sure that'll start to clear itself up pretty fast.
The interesting thing about this has been, and everyone's probably heard this in the news, is just how there have been certain sectors that have been really sort of badly affected, being aviation and tourism. So it'd be interesting to see how governments respond to that and whether they really target that support, which seems to be the approach currently being taken, as opposed to doing something sort of a bit bigger to get everyone spending money and stimulating the economy and encouraging growth and that kind of thing.
Completely. And I just saw a comment down here from one of the viewers saying that investing is good if doing dollar cost averaging, which a lot of Sharesies customers do. And I think that's for anyone using that, that's a very good point. Dollar cost averaging is actually a very poor strategy if you only invest when markets are high. So you need to take this volatility as part of that, which means if that's the strategy you're using, it is important to keep buying in the downs as well as the ups. So we might get onto some of the questions. So the top question that was actually asked was, should we sell and hold and then reinvest again at a lower price?
Look, I think, so this is the thing that everyone's thinking, right, is how much further is the market going to fall? It started falling, and do you jump in now, or is it going to fall a bit more? And that's kind of the big question. But I don't have the answer to that, because if I did, I'd probably be quite rich. But then I think the other important thing to think about is how quickly a recovery might happen. So presumably there will be a recovery, but just how quickly that happens, I think, is the other thing to be mindful of. Generally speaking, and I know this is kind of a boring thing to say, but my personal view is that it's really important to know what your risk profile is. And you know how when you have your KiwiSaver, you might choose growth or conservative or whatever, and then your assets are allocated accordingly. So if you're growth, you might have more equities, less cash, and so on. I mean, that's the way I look at my investment portfolio generally, is across my KiwiSaver and everything, to make sure that those apportionments are aligned with my risk profile. So if I want to get my money out next year to do something, to buy a house or something like that, then I need to make sure I have more cash and less equities. Or if I have 10 years and I'm are able to go through the ups and downs, then I can have more money in equities. And I think as long as you have a plan and you stick to it through ups and downs, for me, that's quite a useful approach. Yeah.
Yeah, cool. I mean, I agree with all of that. I mean, I think selling and holding is absolutely a strategy that people can employ. And I guess the other challenge and the million or billion dollar question, I suppose, that you can see are uncertain is because of how fluctuation is happening in the US in particular during the trading day at the moment. Finding where that bottom is really hard. So if you sell, then you really do risk having to buy at a higher number, or you might do really well and be able to buy lower. But if your strategy was 10 years and you still believe that the investments are good, or you're diversified enough across them, then sometimes they're just buying, using those dollars, accepting that markets go up and down. And when it comes time to sell them, if that's 10 years in time, and assuming the economy does what it's supposed to do, which is continue to grow and geared to do, then you can expect that this dip will just be hardly even noticeable in that sort of trajectory of the market. We've got the next question, which is, I think, a great one, because I know a lot of our Sharesies investors are particularly interested in dividends. And the question is, what do you think the share price decrease will do to dividend payouts? So I might start by answering with my view on this one. So dividends are, in a nutshell, a company paying some of its cash that it holds back out to its investors. And it's one of the ways, of course, as investors, we manage to make a return. The price is always trying to guess what's going to happen in the future. So you're not paying for the value of a company today, you're paying for the value of what the company might be in the future. And part of that includes what dividend it might pay. So the reason some of these things are going down, if we take Air New Zealand, for an example, which pays quite good dividends and has been quite consistent on it, is that investors are thinking that there's a bit of risk to the ability for Air New Zealand to make money in an environment where travel is very hard or risky. So as a result, in the short term, the dividend payouts could be exactly the same, and as a result, those yields that we see on the Sharesies platform and stuff will look a little bit higher. So that's your return. But over time, by nature of this price going down, what we're saying is investors, by setting the market price at that point, is that, hey, we think actually they might struggle to pay the same amount of money out as what they have historically, because business is just going to be a little bit harder. So to round that out, what I'm saying, I think, is there's a lot of uncertainty still. Companies that are focused on paying out dividends will continue to focus on that. But what this uncertainty is causing is us to second guess whether they'll have the same amount of money available due to lack of revenue or sales or something that they've previously had, to be able to pay those same nice ones that we've sort of been experiencing over the last couple of years. So have you got anything to add to that, Jenée?
No, that was great. Yeah, good one.
Well, maybe we'll go on to the next one. So the question that a lot of people are asking is, could this turn into a long-term downward trend, like a bear market? So maybe we could start by explaining what a bear market is. Do you want to take that, Jenée?
Okay, so people are more sort of afraid to invest, and it's, markets are interesting things, aren't they? As we said at the start of this conversation, it is just all about confidence. So if confidence goes too much to the point, people sort of pull right back. Couple of interesting things, though, is that the current environment, I think, is quite interesting, because interest rates are really low at the moment. So previously, like at the GFC, central banks, to try to stimulate the economy, to get people to spend money.
So the GFC was the global financial crisis. So it's the big dip we saw in 2008.
Yes. They cut interest rates because then it was cheaper for people to borrow money. And if it's cheaper to borrow money, the idea is that then households and governments go out and spend money, which then stimulates the economy. And that's what we saw happen this time. Interest rates are really low already. So the official cash rate in New Zealand is already at 1%. So that doesn't really leave a whole lot of room for the Reserve Bank to cut interest rates to get people to spend more money. Because, I mean, if the cost of getting a mortgage was the thing that was stopping you from doing it, the interest rate, I mean, if the interest rates were a little bit lower, you probably weren't going to go out and buy a house or do something because they're already so low. So that means that people currently looking for yield on their investments can't get it from the bond markets. So they're putting it into the share market because that's where they're getting a greater return because these interest rates are so low already. So where I'm going with that is I just think it would be interesting in terms of a recovery because people are still looking for yield, and I sometimes wonder, and I don't really have the answer to this, but whether people are investing in equities more than they otherwise would purely because they're looking for that yield. They're looking for those returns, which have, as you guys know, would have been like 20% and so on. And perhaps they're investing in equity markets, not because they think these companies are amazing and doing great things, but just because they're looking for yield, because of that low interest rate environment. So I don't know what you think about this, Leighton, whether a recovery might be faster than it otherwise would because of this low interest rate environment.
Yeah, I mean, I think I have my own opinions on it, and I've also heard Adrian Orr, who's of course our Reserve Bank governor, speak to some of this, and I think his view on the economy is that we're in a more stable environment for longer. And growing, continue, probably not like we've seen maybe over the last 2 or 3 years, but more stable because of exactly what you've spoken about, interest rates being so low. So I agree with exactly what you've said. I think companies are going to continue to be a great option for investors because it's very hard to make your money work for you in a bank now with savings rates, and that's going to keep demand up. And of course, if there's demand, then demand fuels, investment markets. It's just like anything else, consumer-wise, which is supply and demand help you set the price. So if there's more demand, you can expect the price to increase, and as long as dividends and yield continues to be higher, then I think you're right. I certainly expect the recovery to be faster than what it might otherwise be. And saying that, we definitely don't know the answer, and I think it'll. I think we've set ourselves, but we're probably back about 2 months ago. If you think about stepping back in time price-wise, that's roughly where we are now. So that's also quite a nice way to think about it, actually, because those percentages and those dollar losses can feel so bad, but you think it's actually now just what it was worth 2 months ago.
Just on that point, I talked to a fund manager recently about this idea, and this is before coronavirus, but about this idea that because we're in this low interest rate environment, people are investing in shares purely for yield, not necessarily because of the value of the stock. And his view was that that's what largely contributed to equity markets doing so well. But he thinks now actually fund managers, or he at least, is actually starting to look at the value of the companies, right? Like companies need to be performing well and delivering strongly, and just that search for yield is not necessarily going to be good enough anymore to just keep investors going.
And so just on the bear market, bull market, why it's called that, I think this is just sort of extra fact stuff. So bull market, I think, is because a bull attacks with its head going up. So that's how the bull market sort of came about. And bear market, I think, is because the bear attacks with its paw going down. So that's one of the. I think there's a lot of theories on how those terminologies came about, but it's one we're going to share today.
Sounds good.
So the next question: what's your thoughts on doubling down and putting more into the market at this time?
Go on, Leighton.
Okay, I'll have a first That's this is really into strategy type things. I mean, that is an investment strategy like dollar cost averaging, or picking and choosing stocks, or buying and selling, trying to trade through the day. There's all these different types of investment strategies, and this is one that some people use. So to Jenée's point earlier on whatever your strategy was and sticking with it, if that's what you intended to do, then that's probably what you should do. It's like not a great strategy if you then don't execute on it. But if it wasn't, then it may be taking on additional risk and trying to time the market when maybe that's not really what you're prepped to do, or the risk profile that you were looking for. So I think it really comes down to a independent decision on what you want to do. And and what your risk appetite is, and can you, if it were to continue dropping, can you afford to hold that out for a recovery, which inevitably will almost definitely come. So, anything to add on that, Jenée?
Yeah, no, I think that nails it. That having this, setting a strategy and sticking to it is the key thing. And I mean, that's the other thing that I often think about is how involved do I want to be? Do I want to be sitting there watching markets, timing things, trying to be clever, or have more of a sort of set and forget strategy? So that's, I guess, something that everyone needs to make a decision about.
Completely. Yeah. And I think just looking at some of the chat coming through on the side here, and I think it would be worth, we've talked a little bit about dollar cost averaging, but it'd be probably nice to talk a little about people who are choosing stocks and stuff as well. And I think there's some really good insight coming through. And one of the big things I think about when you're choosing your investments is you're choosing to support a company and possibly something that you have some additional information on that you feel like gives you an advantage over others to be able to choose that as an option. So, and that can be as simple as you really like their product. It might be that you work in a particular industry and you know that there's delay of things coming in, and that might impact the industry more broadly. It's looking at these different pieces of information of things that you can follow, and then applying that to how you might invest. And that's one of the ways you can go about picking and choosing individual stocks.
Mm-hmm.
The other way, of course, is just by setting target prices based on the numbers. And those people doing that should also continue to follow those strategies if that's what they're committed to and want to continue doing. Because once again, investing only when markets up is just a poor investment strategy. It's how you don't really achieve overall better returns, I think. Mm. But it's for some reason the way that all humans feel like it's the nicest way of doing it. Everyone loves going in and buying and just adding to their already well-performing portfolio. If we could do that all the time, it would be great. But unfortunately, it's just not quite how it works.
Yeah.
So one of the questions here is maybe less specific to this. It's around a company called Canis Health, which recently listed on the exchange. For those who don't know, Canis Health is a cannabis production company. There's some questions around here. Is it a good buy, it being medicinal marijuana research company, how it's valued at the moment, some questions around the share price. So anything you'd like to comment on that one, Jenée?
No, I have no idea. I don't know. Yeah. Good to look at the regulatory environment, and obviously everyone knows there's a referendum coming up, and these sorts of things shape it. But you'd have to just look at the fundamentals of the company as you would with any other company.
Yeah, I think for that person there wondering the value of the price of the company and stuff right now, comes back to an earlier point where often we're not valuing the company on the price of what it might be today. We're valuing it on what we think it might be worth into the future. So, and companies like that are probably in the more extreme ends of risk. But that may come with potential really good upside. So it's just going in with eyes wide open on that. And one of the contributors to that will be how the regulatory or government and stuff in that environment unfolds. But I'm sure there'll be a whole bunch of others as well. So it's sort of worth really doing your research on. Mm-hmm. There's one here speaking specifically to the advent of coronavirus. It's talking to the large hit of the American stock market in the last few days, and the question is, do we think the New Zealand trade market will go into recession on the back of that? And if so, will it be as big of a drop as an American and European recession? So maybe we can speak to how some of these recessions have played out in the past and how they've impacted New Zealand, because sometimes we've been relatively protected and other times we've probably felt it a bit more. So have you got some sort of some background to this?
I suppose New Zealand's market has typically been protected, but we are a little island nation reliant on other markets for our exports, as everyone knows, and China is a key one. Don't quite have figures off the top of my head, but I mean, we are so heavily weighted towards China, and we are an outward-looking economy. So I think if things get really bad, maybe we're insulated, but we'll definitely feel it. Just as like to step back to have a broader discussion whether the coronavirus encourages countries like New Zealand to diversify and look beyond China. And I was listening to a podcast this morning, and they were talking about how before coronavirus, China was already starting to, they would use the word decouple from some of the international markets. And this is largely because America and China becoming more protectionist and trying to do things themselves. And the debate on the podcast, which was quite interesting, was whether coronavirus would speed up that decoupling. So speed up that process of countries looking beyond China where they've previously been able to, really penetrate that market and diversify. So this is a kind of big philosophical thing, but it would be interesting to see whether coronavirus is a catalyst that encourages more diversification and how that might actually change the sort of structure of the global market as we've known it for the last few years.
Yeah, that's a really good rundown on sort of what environment and what we've seen now and how New Zealand operates. And I think two key points there, such a reliant economy, New Zealand, on lots of other parts of the world. But I'd also just say the New Zealand economy is very strong at the moment and probably is in one of the better positions globally to support initiatives that might help the economy start to grow again as those lags happen. So I think, to my point earlier, there have been times where we've recovered much slower than other places and times where we've almost seemed like we're not impacted by it. So it'll be interesting to see how that plays out. But what I will say is when something happens in the US, you can almost guarantee at least the market open in New Zealand, there's some sort of correlation to what happened there, and then we work it out through the day.
Yeah.
I would say the construction industry is going strong. Sorry for to those people who can hear that drilling going on. I think someone's run off to try and make sure that stops for the moment, but we'll try to get that sorted. So yeah, there's.
Can I just add, before we move on, I'll just add a point on that. So yeah, in terms of the New Zealand economy, it is strong at the moment, relatively speaking. So, I mean, our GDP, so like our economic growth has slowed, but the government still has a surplus, even though a deficit is forecast for the next year, just a small deficit. But there is a bit of wiggle room. We don't, as the government will keep repeating at length, which is a bit annoying, it is meeting its budget responsibility rules. So there is actually quite a bit more room for the government to borrow more, to spend more. And I think it will be interesting to see if things really kick off with coronavirus, the way the government might respond. So Treasury is busy looking into it at the moment, as you would expect they would, looking at whether they might do, worst case scenario, do helicopter money. So basically put $2,000 in all of our bank accounts, or do some sort of a tax cut, or just really get that fiscal stimulus going. So allocate much more money to investing more to stimulate the economy. People are thinking that might be a better solution should things get really bad, versus the Reserve Bank cutting interest rates, as I said before, making it even cheaper to borrow money, encouraging people to spend that way. But there are some tools that can be used. And I think actually as we speak, Finance Minister Grant Robertson is doing a speech in which he's outlining some of the scenarios that Treasury is looking at and some of the responses that could happen. And I think in Hong Kong they've announced that the government there is basically just dishing out cash to get people spending. So it'll be interesting to see whether that actually does stimulate things, or whether people just take their cash and pay off some debt or pop it in the bank or don't actually do anything with it. But yeah.
Great update. Thank you. I didn't realise that announcement was on right now, so follow that with interest this afternoon.
Yeah.
The next question was, given the dip in the market, what would your advice be to new investors? So I guess we should reiterate, not financial advisors, but I think we can probably maybe just give an opinion of what we tell any investor if it was based on some largely well proven theory now, I think, on that. So I don't think it's specific to new investors, but experiencing this type of downturn in the early stage of your investing journey is probably a really good thing, because one of the big things about investors is getting comfortable with these ups and downs. So what do you think about that, the comment specific to new investors, Jenée?
I mean, you make a good point. The values of stocks are falling, so it's a good time to buy them. But I suppose for new investors, as much as it is for anyone, you have to have a stomach made of steel. So if you invest now and in a week's time your values drop, don't panic and then pull out, because you'll be locking in your losses. You'll be pulling out, and you won't give your investment time to recoup those losses. So I guess if you decide you want to invest, as we've said before, pick a strategy and just stick to it. And I guess just if it's what you want to do, just be committed to it. Don't sort of dilly-dally, jump in and then pull out and so on. And actually, I mean, the thing is, because it is great that it is so easy to invest nowadays, with platforms like Sharesies and Invest Now and Hatch. It's cheaper, it's easier, but it's not a game. It's still there's still risk involved, and you still need to take it seriously.
Yeah, I think investing is so behavioural based, isn't it? Or like anything really, if you want to be good at something, it's worth getting your behaviours sort of first. Sometimes we start to focus on other things, but so there's a few tricks I use sometimes to sort of make myself feel good about it. So it's like, right, well, when markets are a bit bumpier, then maybe choose something else to focus on, like not just the return on it. Like it might be the average price that you've paid for an investment. So if you do continue to buy on these, then you can sort of potentially make that a bit lower over time. Focus on the number of shares you hold, because the shares are still the shares. It's like we often talk around Sharesies about how it's so different to property, because the share market, because in reality, when these areas of uncertainty happens, it happens across the market, but we're not going to go home today to our letterbox and see a big red down arrow and saying, hey, you've lost $10,000 on the value of your house today or something. It's like, what are the things in your behaviours that might be able to make you still feel positive about investing, putting away, and understand that this is a long game, and stick with that strategy, because it's almost definitely still going to be the right one. We're getting towards the end of our time here. So I think a lot of the questions are covering a lot of what we've talked about already. And for those who are asking, this video is going to be up. Available on YouTube afterwards as well, if there's been any interruption. But I think maybe if we could summarize a few thoughts on the dip, and some takeaways for people who have been a little bit concerned, and maybe you could try a bit of a wrap up first, Jenée, and then Lever afterwards.
Okay. Right. So for me personally, I try to avoid watching daily market fluctuations, and I mean that fits in with my longer term strategy. If you have a shorter term strategy, you might want to be looking at it more, but this is what markets do, right? They go up and they go down, and for a long time now we've gotten used to markets going up and seeing really high returns. So I think it's important to stay focused on your strategy, and also this is a sort of moving beast. So while it's really useful to look back at what's happened at the past, I think there are some things in the current economy that are different to what we've seen in the past. So I'm interested to see how that might actually change things looking ahead. So the key thing there is the fact that interest rates are already really low. And something else which Liam Dan from the Herald wrote about, which we haven't discussed, is how banks are a bit stronger now, quite a lot stronger than they were back in the 2008 global financial crisis, where they weren't quite so keen to. There was a credit crunch, and we're not quite in that same scenario now. So it is interesting to look back historically and to see what's happened, but also there's some quite different factors in the market at the moment which make it quite difficult to look ahead and know what's going to happen.
Yeah, awesome. I think, I mean, I agree with everything you've just said. I think there's a few key points to remember, which is this whole thing of uncertainty. So it's remembering that the reason this is happening is because people are just not quite sure what's going to happen. And when you're valuing a stock, it's normally valuing what you think it's going to be in the future, not right now. So it's yet to be seen, but there's potential there will be very little impact at all. And there's potential there might be quite material impact, but companies are very, very good at adjusting their strategies to accommodate those. So one of the things I'm sure most companies who think they might be impacted are doing right now among many management teams would be working out, well, how are we going to change our business to accommodate what is a changing environment for us. The next thing is for those who do use dollar cost averaging as a strategy, which, like I say, I know many Sharesies investors do. It's is just never to forget that only buying when it's going up is just a really poor way of executing that strategy. It's not how you get the best out of it. You have to buy when the sort of cheaper opportunities available as well for those ones. And then I think something we've spoken about a lot is whatever your strategy was a week ago when markets were going great is probably still relevant today where it's been a little bit rougher. And in saying that, today we've seen a little bit of recovery on markets and a little calmer in the US overnight, but who knows what tomorrow will hold. And if we could guess that, as you say, Jenée, we'll probably be on some boat somewhere in the Caribbean and really enjoying it. But hey, we're going to wrap it up there. Thank you so much to everyone who tuned in. Jenée, thank you so much for joining us. It's so great to have your insight on expert knowledge economies.
Oh, thanks for having me, and thanks for tuning in, everyone. Hope it's been helpful.
That's great. Thanks, and have an amazing day, everyone. And this will be up on YouTube soon. And I'm sure we'll be in touch with any tips and any questions. Keep sending them through, and we'll make sure the team get back to them as soon as possible. Thanks. Have a great day.